The stock market, a place where fortunes are made, but also where they can vanish in the blink of an eye. With every high, there's a looming low. Today, we are diving deep into one of the most crucial yet often underestimated aspects of stock market investing: managing risk. Whether you're a newbie or a seasoned pro, understanding and mitigating risk is your only ticket to long-term success in the stock market. And trust me, by the end of this video, you'll be looking at risk in a whole new light. Risk is an inseparable part of stock market investing. Yet, while most of us are constantly chasing high returns, we often neglect the potential risks that come with it. To be a successful investor, it's not about avoiding risk, but managing it smartly. In today's video, we'll go through actionable strategies that not only protect your investments, but also position you to benefit even when the market seems unpredictable. And don't worry, this is not just another basic talk about diversification. We're going to explore strategies that can add real value to even the most experienced investors. Understanding different types of risks. Let's first break down the types of risks every investor should be aware of. Why? Because you can't manage something unless you understand it fully. 1. Market risk. The most obvious one, right? It's the risk of losing money due to movements in market prices. This is something everyone faces. But here's a fact that many overlook. Different sectors within the market react differently to external events. For instance, financial stocks might take a nosedive due to some regulation, while defensive stocks like pharma and utilities might still thrive. So how do you shield yourself from a total meltdown when the market turns red? We'll get to that shortly. 2. Interest rate risk. Interest rates affect everything, not just your loans. When interest rates rise, companies find it more expensive to borrow, and as a result, their stock prices might decline. Understanding this connection is crucial, especially if your portfolio is heavily weighted in interest rate-sensitive industries like banking or real estate. 3. Inflation risk. Many investors, especially long-term ones, forget to factor in inflation. What if your 10% return gets eaten up by 6% inflation? Your real return then is just 4%. The silent killer, inflation risk, is a lot more dangerous than most people realize. 4th, credit risk. If you invest in bonds, especially corporate bonds, credit risk is your enemy. It's the risk that a company or government won't be able to repay its debt. Even big companies aren't immune to this. Think of Lehman Brothers during the 2008 crisis. Diversifying between high-yield and safer bonds could mitigate this. 5. Liquidity risk. Imagine needing to sell a stock but finding no buyers. Liquidity risk can trap investors, especially during times of market panic. Strategies to manage and mitigate these risks. All right, now that we know the various risks, how do we manage them? Here's where things get interesting. Let's look at actionable strategies that top investors use. 1. Diversification, beyond the basics. Diversification isn't just about holding different stocks. It's about holding different kinds of assets. Stocks, bonds, real estate, and even commodities like gold can offer protection. The key is to look for assets that don't move together. This is known as low correlation. When stocks fall, bonds may rise. When inflation kicks in, commodities like gold might protect your wealth. But did you know there's a twist to diversification that most people miss? It's called geographic diversification. 2. Geographic diversification. Don't limit yourself to domestic markets. Emerging markets, though volatile, often don't correlate with developed ones. For example, during the 2008 crisis, some Asian markets recovered faster than Western ones. By investing internationally, you spread out your risk across multiple economies. 3. Hedging with derivatives. Now, this one's for the more advanced investors. Have you ever thought of using options or futures to hedge your portfolio? These instruments can provide downside protection. Let's say you have a large position in a tech stock. You could buy a put option on that stock to protect yourself in case it drops suddenly. It's like insurance for your portfolio. This technique is commonly used by institutional investors but can be equally valuable for individuals if used wisely and strategically. Fourth, asset allocation based on risk appetite. One of the best strategies is dynamically adjusting your asset allocation based on your risk appetite and market conditions. Are we in a bull market? Then, perhaps a 70% equity and 30% bond mix works for you. But during a bear market or periods of uncertainty, dialing back your equity exposure to 50% or less could help preserve capital. But here's a little secret. Even timing your entry and exit points can play a huge role in risk management. That's where rebalancing comes in. The power of rebalancing. As markets move, your portfolio's balance can shift. Stocks might outperform, leaving you overweight in equities and underweight in safer bonds. Regularly rebalancing your portfolio brings your asset mix back to the right level of risk you're comfortable with. This is critical because during market highs, investors often become too greedy, only to suffer the consequences when the market reverses. Sixth, risk-adjusted returns, a must-know metric. Experienced investors focus not just on returns, but risk-adjusted returns. Simply put, this metric tells you how much risk you're taking on for each unit of return. A high-risk investment that yields 12% may not be as attractive as a lower-risk investment yielding 8% when adjusted for risk. Eye-opening facts and examples. Here's an interesting fact. According to historical data, only about 4% of stocks account for all the wealth creation in the stock market over the past century. What does this mean for you? Chasing individual stock picks is inherently risky. Many seasoned investors now prefer broad market indices or ETFs, as they allow exposure to a wide range of successful companies while minimizing the risk of catastrophic loss in any single stock. Remember the dot-com bubble? Investors who were heavily invested in tech stocks lost nearly everything, but those who had diversified into bonds, commodities, or even international markets fared much better. As we conclude, managing risk is the cornerstone of successful investing. It's not about avoiding risk entirely. That's impossible. Rather, it's about being smart with the risks you take and implementing strategies that can safeguard your investments while still allowing you to grow wealth over time. From diversifying globally to using tools like options, managing your portfolio with a risk-first mindset can turn the odds in your favor. As they say, if you take care of the downside, upside will take care of itself. Remember, the stock market can be your friend, but only if you treat it with respect. Managing risk isn't just for the professionals. It's for anyone who wants to invest wisely and sleep peacefully at night. For a one-to-one discussion with a highly experienced finance professional who always keeps your interest ahead of everything, you can write to us at info@eacapital.in and one of our team members will get in touch with you.